Hello everyone. Good afternoon. Welcome and thank you all for accepting the invitation at the first OTP Bank macroeconomic webinar on global and local markets of this year. My name is Alexandru Angel and I will present this event, which will last for about 1 hour. So, today, during this webinar, we will approach the current economic status and context, and also future prospects by sharing important macroeconomic insights and looking at how recent market and policy shifts have impacted the economy. Before we begin, I have a few housekeeping notes to share. So today's session is being recorded, and all speeches and presentations will be held in English. Of course, translation is being provided. So for Romanian, please press the translation button. Please keep your microphones on mute during the event and your cameras on. We like the audience. So if you have any questions for the presenters, please address them in the chat feature and post the questions right there so that the presenter can answer during the Q&A session. Also, please mention which presenter you are addressing the question to. So now, going further, let me introduce the keynote speakers. Today, with us, there is Gyula Father, CEO of OTP Bank Romania, Gheorghe Tardos, Chief Economist, Head of OTP Bank's Research Center, and Mihai Kovac, Economic Advisor at OTP Bank's Research Center. Now, let's please welcome our first presenter, Mr. Gyula Father, CEO of OTP Bank Romania. Sir?
Thank you. Thank you, Alex, for the introduction. Dear partners, thank you for accepting the invitation and welcome to our quarterly macroeconomic webinar. As you are accustomed by now, during the next hour we will present valuable macroeconomic and market insights, and our goal here is to help you understand the current context and make informed decisions about your business and your personal plans. Before we dive into our analysis, I want to update you on OTP Bank Romania's progress. As you may already know, we are coming near to the end of our 5-year growth program, which means that in 2022, we underwent a period of consolidation. After many years of very fast growth, it was an important part of our activity, which in turn will allow us to be ready for the next growth wave. Despite the challenges we all faced in the continuously changing market conditions, in 2022, we have achieved an on-growth portfolio of 9%. In addition, we have registered a record operational result and managed to decrease the non-performing loan ratio as well, while also building conservative provisions for unexpected losses and events in the future. Altogether, the Romanian banking system performed very well and remains stable with great capacity to respond to new macroeconomic challenges and developments. And so it is OTP Bank Romania. Now, our focus, as in the past years, remains on supporting the Romanian economy, financing the local businesses and individuals, of course, while maintaining our customer-centric approach. Regarding developments, we have invested heavily in increasing and optimizing our operational capabilities, our products and services with a great deal of care for digital channels. As we understand the importance of digitalization, we have not neglected the human side of our interaction with the clients because we understand the significance of personal relationships and its key role in our customer experience. Our primary goal is to understand the challenges that our clients face, provide the right tools and expertise to overcome them, and together find the new opportunities to grow, build new partnerships and successful projects. This is the exact purpose of this series of events, sharing valuable macroeconomic insights to help you stay ahead of the curve. Our team has thoroughly researched and prepared all the necessary details in this regard, and I encourage you to actively engage and at the end of the session, ask your questions. Here are what we provide you with the best possible advice and support. Thank you for joining us today, and we look forward to working with you to achieve your goals. Thank you. And back to you, Alex.
Thank you, sir. And now we'll go towards the presentation. And Mr. Gheorghe Tarduș will begin with some interesting information.
Hi, good afternoon to everyone. Regarding the current situation, I think that the main message is that after the really strong growth of 2022, Romania is facing a slowdown this year. We think that after inflation reached extremely high levels everywhere in the world, and also in Romania it rose to really high levels. I think that the peak is behind us, and looking ahead, we expect relatively fast disinflation in the Romanian economy, and we think that the National Bank of Romania finished with the rate hiking cycle. For the beginning, here you can see our forecast from the October projection and the outcomes. Mishi, can we go to the next slide? Yes, thank you. Regarding last year results and this year outlook, so due to the tough, difficult, and a bit hostile external environment, we think that in the first half of the year, the Romanian economy will slow down. So annual growth could be just below 3% after the very strong growth of 2022. Regarding inflation, after the peak, we can see that this inflation can be fast, and by the end of the year, inflation could go down to 6.5%, and on average, inflation can be just above 10% in the Romanian economy. We think that the central bank could keep the base rate around the current level in the first half of the year. Where we can see negative risk around growth, that's the external environment, and it also should be emphasized that loan growth in Romania slowed down at the end of last year. It's not a unique phenomenon. In many regional economies the same happened, and also in the Eurozone loan origination slowed down, but we think that this should be mentioned as a negative risk for the growth outlook. Regarding the external environment, we think that this is really difficult and really unfavorable for the regional economies. Simply too many important factors has been changed within a very short period of time. In geopolitics, the war Russia started against Ukraine means that Russia is decoupling from the West, and trade links are broken likely for an extended period. We also see that tensions between the US and China are on the rise, and Russia decoupling from the West and China might follow means that globalization, as we know, won't go on. Very likely we can see at least a slowdown or even a reversal. This can put further pressure on supply chain problems. And it also should be emphasized that defense spending will be increased in the world, and that can increase the demand for funds, and that can result in higher interest rate environment. In the economy, we have the energy crisis. Luckily, the pressure moderated a lot since the autumn. Nevertheless, inflation is very high. Central banks in the world are hiking interest rates, and the higher interest rate environment will stay us for a while. High inflation became a drag on economic growth and consumption because real wages are falling and investors are much more cautious, and higher risk aversion means that demand for regional assets could be weaker. And most recently, tensions rose in the US and the European banking system, namely few banks defaulted. And this can be also a major factor. As long as these banking defaults are organized, I think that the, let's say, effect on the region is moderate, and we can hope that these defaults remain organized because regulators would like to avoid any unorganized default, and very high or much higher capital buffers provide them the opportunity to do this. But even with these problems, we can say that very likely that risk aversion will remain high, and that can be, let's say, a drag on the loan supply globally, and that can be a drag on growth as well. Because of high inflation, falling real wages, tighter monetary conditions, economic growth slowed down significantly in the developed world. Actually, the US and the euro area get close to the recession. Actually, growth went down sharply, and the big question, what would happen this year? We have also some good news. Food prices fell last year, energy prices fell a lot from the peak. Actually, gas prices fell nearly 90% from their peak, which means that global inflation pressures are moderate, and this inflation is actually started, helped by lower energy and food prices. European gas and electricity prices also fell a lot, actually from levels which have been high enough to cause, let's say, a sizable recession in Europe. These prices went down. They are still twice as high as they used to be before the energy shortage started in 2021, but these levels are low enough to live with them for a longer period, and I think that would help the European economy to grow a bit faster in the second half of the year with the start of the new heating season. We cannot be sure that the current low level of gas prices will be maintained for the next 2 years, because in the heating season, which just coming to an end, high prices push down demand and let a lot of LNG gas to arrive to Europe, and therefore this contributed to an equilibrium. It was also a key factor that the winter was very mild, and gas use was well below the usual patterns. Looking ahead on the middle run, as long as Europe lacks enough LNG capacities, the equilibrium is really fragile. So it cannot be ruled out that prices will increase in the autumn, but I think that this potential increase would be well below the madness what we saw last year. In the developed economies, after hitting 4-decade highs, inflation started to come down. Nevertheless, this disinflation process, especially in January and February, was slower than expected, because repricing in these economies rebounds, and this suggests that disinflation won't be an easy ride, also on the core markets. Regarding the interest rate environment, it was extremely volatile because of higher than expected inflation in January and February. Interest rate expectations in the US and in the Eurozone increased nearly by 100 basis points. After that, when the banking defaults started, expected interest rate peaks have fallen because the market believed that central banks will focus much more on financial stability than on inflation. Since then, it became clear that central banks can phase out the problematic participants relatively smoothly, and since then, I would say that again, expectations on maybe further tightening started to build up, but I would say that likely interest rate hikes will not reach the level what was expected, let's say, 1 month ago. As long as the Western European central banks and authorities could manage banking problems properly, I think the region can be relatively, let's say, relaxed with this process. And luckily, because of much tighter regulations, capital buffers around the world in the banking system are much higher than they used to be around 2007 and 2008. And this higher capital buffer means stronger resilience in the banking sector and means larger maneuvering room for the regulators to, let's say, manage any problematic banks and phase them out without any serious damage to the depositors and to interbank markets. In the last 2 months, recession fears in the developed economies moderated because of better than expected business cycle data. However, these numbers are not reflecting the effects of these banking problems in the Western, so in the US and in Europe. Current growth outlook for the major economies suggests that despite the slowdown, despite the strong pressures on economic growth, the developed economies might avoid recession this year before accelerating to around 1.5% in 2024. However, because of the large uncertainty around the interest rate environment and because of these banking system problems in the US, I would say that we should emphasize that risks are tilted to the downside. Regarding inflation, as I mentioned, disinflation already started. Market participants are relatively optimistic about the inflation outlook. The consensus says that by the end of the year, inflation could moderate back to around the, let's say, inflation targets and could reach it by the end of 2024. Thank you for your attention, and I would like to give the word to Mihai.
Thank you. Hello, everyone. So moving on to the situation in the Romanian economy, first starting with the incoming data. While Gergely described that major economies in major Western economies has slowed down recently by the end of the year, in fact, it was already a surprise that euro area could avoid a recession in Q4. the Romanian economy managed to increase its growth rate from the third to the fourth quarter. So year-on-year GDP growth picked up from 3.8 to 4.6%. And if one looks at the details behind this result, which is shown in this chart, we can conclude that one most important factor was the pickup in construction activity, which is indicated in red on this bar chart. This is driven by the increased infrastructure spending in the economy, primarily by increasing infrastructure spending via the use of European Union funds. As in Romania, government investment started from a relatively low level a few years before. There was room to pick up quite significantly, so we could have observed double-digit growth rates in consumption. The other factor was more like in the pickup was more like a short term. It's indicated by this green area, while in Q3 agriculture fell substantially on year-on-year basis. Q4 this fall has moderated, so it was much smaller. Naturally, it didn't add to growth per se, but it compared to the previous quarter, it helped the growth figures to improve. And while industry was relatively struggling, so you can see this this orange-brown color, which remained in the negative territory. The different segments of the service sector performed relatively solid, both in the third and the fourth quarter, and these gave the biggest growth contribution overall in the two quarters together. If one asks the question, what happens this year so far, we have some hard indicators for January, and for February we already have some confidence indices, and from this relatively let's say diverse picture emerges. But the conclusion for us is that there's clearly a slowdown. What drives, obviously, the slowdown is the construction activity, which you can see with this gray line. It's slowing sharply, although still in the positive territory. At the same time, industry is falling. If you look at the details, the fall in industrial production, well, first of all, it's not a new phenomenon in the Romanian economy. So contrary to other CE economies, industry has not really expanded for a few years. But now we think, and if you look at the details, it shows that the energy-intensive industries faced the biggest problem. We might have heard some closures, temporary closures as well. And at the same time, private services picked up from December to January, but obviously, if you look at in a more general trend, there's also a slowdown, which is understandable because part of last year sharp growth in Q3, it was also a COVID recovery, partly a COVID recovery effect, let's say so. And retail sales, that's relatively stable, shows relatively stable, robust growth around 4 or 5%. In fact, so far it hadn't been really hit by the fall in real wages, which the Romanian economy experienced in the last half year. And if you look at the sentiment indices, and we also have some other short-term indicators, what can be seen is that the weakening from the, let's say, last autumn to January occurred, a weakening, and since then February brought some mild correction. But the general picture is for the first quarter of the year is still a slowdown in GDP growth. We expect around 2.5% plus GDP growth in Q1 and probably also in Q2. And then the economy could pick up later on. And this means that that annual GDP growth, as Gergely mentioned, it will be around, our forecast is 2.8, but let's say it could be around 2.5 and 3% to pick up later on. we allocate most of the slowdown on the demand side to household consumption, which is this red component in this GDP contribution chart, while investment will keep a solid growth to economic development, primarily through these EU fund projects and infrastructure investment, while housing it more likely to weaken. And at the same time, we still think that the net export as a component of GDP will remain negative, although its negative contribution will diminish as the external balance improves. One interesting question behind the growth slowdown is what's happening on the labor market. And what we can see is that it's two things. On the one hand, if compare, like last time when we had the webinar in October, we said that the labor market has remained robust and employment has been growing, unemployment remained very low. And since then, the story has slightly changed. I wouldn't exaggerate this, but at least as another sign of some weakening in activity, the employment growth has slowed. In fact, by the end of last year, early this year, employment almost flatlined. You can see this on this purple line on the chart. At the same time, by the end of the year, there has been some smaller increase in unemployment. But this increase in the last 2-3 months has stopped already. So we don't see a substantial deterioration in labor market conditions, but in any case, it shows some weakening compared to previous trends. And this is also shown from another angle by the so-called labor market tightness indicators, which measures to what extent the labor demand and labor supply are in balance. And we use two indicators for this. The red one is a kind of survey-based, and the black is a more hard-based, which compares job vacancies and the number of unemployed. And you can see that while after the recovery from the COVID, labor demand was excessive, so both these indicators increased. In the last few quarters, there has been a decline in these indicators. And especially for Q1, where we have this survey indicator, we have a further decline. So it again shows that the balance of labor demand and supply moved from a relatively excessive demand situation to a more balanced situation. And it's yet to be seen how this continues. But given that in the baseline, we expect a moderate slowdown in GDP activity, we don't think that it will deteriorate substantially further. On the other hand, if we look at the wages, so far on the labor market, we spoke about the quantity part. If we look at the wages, there has been a persistent decline in real wages in the last half year, at least, let's say so. But by January, this fall in the real wages has stopped. And this has two components. The most important component is that wages picked up by, let's say, 2 percentage points. The whole economy net wages grew around 15%, but the private sector almost by 17%. At the same time, we know that inflation has slowed. Actually, the January figure was 15.1%. So this meant that the balance between wages and inflation changed. And we think that this tendency will, to some extent, prevail. And actually, it's observable in a lot of other regional economies that several employees or most employees experienced the real wage fall last year because of the surprisingly high inflation. And now they are partly compensated given the relatively tight labor market situation, even if it's not that tight, let's say that half a year ago. And this means that as they are compensated, on the other hand, inflation is coming down, the fall in real wages has ended. And we expect this to continue, this trend, in fact, real wages to move into a positive territory, which is very good news from the point of view of economic growth. At the same time, it's a question whether to what extent this will jeopardize the anti-inflation efforts of the central bank. We will see. In the baseline, we don't expect a major problem from wage growth. Moving towards the balance indicators, as regards the fiscal balance, the 2022 deficit turned out at 5.8% of GDP. This was below our expectation. We expected like 6.5% or slightly less, although this is just, I don't want to go into very much details, but it's the so-called cash-based deficit, which is the green line, while what the European Commission and the EU looks at and where this 3% target is set, it's the national accounts or ESA-based deficit. For that, we only have data up to Q3, which was 5.5% deficit. What we see is that up to February, where we have cash data, after the huge improvement, let's say from the period of COVID until last October, November, there was a huge improvement, and afterwards some renewed deterioration occurred. As far as we know, this is partly in line with our view of weakening activity. So in the first 2 months of the year, as one can follow, the VAT receipt came below expectation, but also expenditures picked up somewhat. At the same time, while early this year, or to the most recent indicators, the fiscal budget situation slightly worsened, although I wouldn't exaggerate this. The uninterrupted deterioration in the current account, which occurred practically from 2020 until last autumn, has started to turn back. You can see this on this blue line on this chart. And given that it was not the fiscal situation, but improved in the last 2 or 3 months, we think that it's the private sector balance which has obviously improved, and it's partly related to the falling energy prices, what Gerg just described at the beginning. Moving on to the inflation situation, we understand that inflation is clearly over the peak. The peak was somewhere in the autumn, around 16.5% or roughly that. January was already like 15.1. There was some correction up in February, driven by the household energy prices, which although they are fixed for most, but in the accounting of the statistics, they change slightly from one month to another, and there are some base effects as well. But the important point is that inflation is, like, let's say, over the autumn peak now for at least 5 months. At the same time, the core inflation component, so the component which excludes the volatile food and energy components, you can see the green line here, it was still moving up, although it stood around 8.5%, which actually I would say it's relatively good in a Central and Eastern European comparison. And if you look at the short-term outlook, what you can observe that what also confirms that we are over the peak is that the pricing intentions of firms are coming down. It's especially visible in the goods producing sector. So on the upper chart, you can see the red line is the pricing intention of the goods producing sector, and you can see that it's already clearly moving downward. There's some lag why this pricing intention change might appear in the year-on-year goods inflation, but obviously the increase has already stopped and we expect a decline. With regard to services, which is on the lower chart, again, the red is the pricing intention, the green is the actual service inflation data. What you can observe is that we are over the peak, but the decline in intention to raise prices is much more moderate. So we are more concerned here, or here is a more persistent component. But it's again not something which is only typical for Romania. In fact, in most of the economies we cover, what happened that last year was more about the increase in food and goods inflation. In goods inflation, what mattered also, apart from exchange rate changes, maybe not in Romania, but for example in Hungary, because in Romania there was no weakening in the exchange rate, but what mattered everywhere is the supply chain problems after the COVID recovery, and as these supply chain problems eased, goods inflation has started to improve. On the other hand, in the service inflation, the situation is that the most important cost component in services is labor cost, and as wages moved gradually up throughout the year, and usually repricing in services is less frequent than in other segments. There was a big increase in pricing in the early part of the year. And as a consequence of what we told so far for the outlook, here you can see our inflation projection. We are now have at the February data. We expect a decline below 15% by March, and actually a much bigger fall by April. So the black line is the headline inflation, and the different colors are the different components in the consumer price index. And you can see that at the beginning, the big fall is driven by the decrease in the energy component, this purple part, because due to base effects, the year-on-year rate will fall sharply. So the big increase in energy prices, in household energy prices, occurred roughly last April. And after this, you can see that there's a gradual declining component from food, which is the dark blue, as well as non-energy goods. And the service component is more persistent. And the setup of all this is that, as Gergely mentioned at the beginning, that we expect a relatively stiff disinflation, meaning that end-year inflation could be between 6-7%, or forecast is 7.5%. We will see naturally there's an uncertainty around this, 6.5%, or forecast. Naturally there's an uncertainty around this projection. Moving from inflation to monetary policy, last time the National Bank of Romania already kept the policy rate at 7%. The last increase was last November, I think, when they raised to 7%, and in February they kept at 7%. We think that this is already the end of the rate hike cycle. Actually, we also expected at our last webinar that the end of the rate hike cycle could be around 7%. And we have several arguments for this. First of all, inflation. As just how I described, inflation is clearly over the peak. And as inflation is coming down, there is less need to tighten. Economic activity is weakening. Another factor which might point to the finishing of exchange rate tightening. And in fact, the market also prices an end of the tightening cycle. You can see, for example, on this chart where we depicted the policy rate and the 3-month repo rate. And in the period when there was the expectation of tightening, the 3-month repo rate was moving well ahead of the policy rate. And by now, due to the decline in the repo rate and the increase in the policy rate, they are practically at the same level at 7%. And if you look at the total yield curve, which is shown on this chart, the latest figure is like this orange color. We can say that actually the whole yield curve is around 6.5–7%. So from being a relatively steep yield curve last year, now we are at a practically flat yield curve. We think that given the uncertainties, and especially this banking sector problem, which has a negative global banking sector problems, which has a negative effect on risk appetite toward emerging markets, the Romanian central bank would keep the base rate at 7% until the mid of this year, and then later on, once we have a clearly one-digit inflation level, they will start a gradual cutting cycle. And this is something actually which can be quite helpful for loan growth and banking sector activity, because as partly what Gergely mentioned in the summary, lending activity has slowed substantially in Romania in the second half of last year. We observed it also in other countries, but probably Romania was among the countries where it exerted a relatively strong influence. And by earlier this year, the corporate sector slowdown has stopped, but the housing and consumer part goes uninterruptedly. We can see also this from, if we don't look at the year-on-year growth rates, but if you look at the net credit flows, loan generation minus amortization, so this is the impulse from the credit side, what's going on to the economy, and you can see that basically it's around zero in the consumer and housing segment for, let's say, half a year, and it was very weak in the last, in Q4 in 2022, and now in the corporate segment there has been some pickup. One can ask why this slowdown happened. Naturally, part of the reason was the higher interest rate environment as policy of the central bank was tightened. The interest rates alone increased, which had a negative influence on demand. But given that if we are right, and now it's over the peak in the interest rate, and later on there can be a gradual decline in the key interest rate, in the second half of the year, it probably can start to give a positive impetus to lending. It's a question to what extent the global banking sector problem might have an effect on lending in Romania. In the baseline, we don't think that it will have a sharp effect. So overall, we think that with the lower interest rate in the second half of the year, there can be some improvement in lending. And basically, this was what I wanted to say about the Romanian economy, and I would give the floor back here. I just repeated or summary messages. Thank you.
All right. Thank you, Mihai. Thank you, Gergely. That was some very interesting info and full of data. We'll take some time to, let's say, sink into this. But first of all, let's go to the question part of this webinar. And as I can see from our guests here, we have some questions about. Firstly, about the GDP forecast for this year. What are the main drivers that, or maybe, let's say, where the pickup will be faster? In which sectors the pickup will be faster for the, let's say, GDP forecast growth in 2023? Will we have some star sectors, let's say, in the local economy?
Yes. So, in fact. If you look at the components of like for the projection, I presented here only the demand side part. Regarding the sectoral part, we think that there can be some upside in construction if the interest rate environment will decline. We can have some upside in industry as long as there has been a sharp fall in energy prices, and if that feeds through to the end users. We can have some improvement in retail if it's true what we say that real wages will start to increase. We don't really expect an improvement in the private services because it has been growing very fast last year, and it was driven by partly a COVID recovery, as I mentioned. So that one I wouldn't mention at this stage. So several candidates. We will see. Naturally, for example, the performance of the industry also depends on what happens with the Eurozone economic activity. Currently, as Gergely said, we don't expect there a recession, which is a good news, but we will see what incoming data will show.
I see. Besides the international banking situation, let's say, are there any serious danger that could overturn this forecast, or maybe push back the inflation to 15% in this spring, this early summer?
Well, we don't think it's a reality for inflation to go back to 15%. As an analyst, you can always find some factors. Should there be a renewed energy crisis, very substantial fall in the exchange rate, but none of this. Another food shock can occur if the harvest will be very weak. But again, like last year, in both the energy situation and the food price situation was relatively severe. So you would need to have an even worse situation to repeat such additional effects to inflation. So we don't think it's as a reality. One can debate the pace of inflation decline. So it's still possible. For example, just let me quickly move to this chart. It's still possible that, let's say, due to higher wages, the service sector inflation will be somewhat higher than we envisage. This green contribution can be larger, or the red contribution because of, I don't know, renewed supply chain fears. But again, from this chart, you can see that already a large chunk of the decline is due to the base effect of energy prices not increasing further. So you would need to have these factors that I mentioned, the service and food or whatever, these could not affect such a magnitude that from, let's say, 10%, they could quickly push up to 15%. Naturally, you never say never, but so far, given the likelihoods, this is what we think. The inflation can be a bit higher if negative risks materialize, but clearly it will be on a downward path in our view.
All right. Thank you. And now another question regarding yields, very interesting one. Where do you see the yields of Romanian government bonds in lei, in RON, at the end of this year?
Well,
if the estimate can be done, of course.
We have some figures, I mean, but so I don't have a baseline forecast in my mind. But I think if things go around our baseline, they could slightly decline from the current level of 10-year bond around 7%. But we don't expect a major decline, as far as I remember. If, for example, due to some renewed fears on the banking sector in US or Europe emerge, naturally the traditional channel is that it decreases the risk appetite towards emerging market assets like Romanian bonds. Then we can have some slight upward movements, but we don't expect this in the baseline.
So, if I may, that's we expect something like 60-80 basis point fall on the long end of the yield curve in Romania lei. Based on that, looking ahead, the interest rate in the environment will moderate a bit after reaching the peak not so long ago. So maybe that should be interpreted as a baseline scenario. So we expect some moderation by the end of the year. Nevertheless, it's heavily depending on the global risk appetite.
All right. Thank you, Gergely. And now let's move back to the monetary policy questions. What was the cause of the 3 months or 6 months ROBOR departure from the policy rate corridor through 2022? And what could have caused the ROBOR rates to drop?
Can you hear me? Sorry, because I think I have a...
No. So the problem should be
on the next slide. So
yeah.
Okay.
I think the question was that what we expect for the policy rates.
Yes. So as I mentioned, we expect the policy rate should to be kept at this 7% level until let's say June, and then gradual cuts later on. And our end-year forecast for the policy rate is 6.25, so 6.25, and then a further 75 basis point next year. I think there was also a component in the question, probably, that why the ROBOR increase was so steep and then declined. I also tried to refer to this by saying that when during 2021 the interest rate expectations or expectation of hiking interest rate by the central bank increased, this naturally drove 3 months interest rate higher than the actual policy rate. And as these expectations have been fulfilled and or mostly fulfilled, and the further hike expectation faded, there was no reason the ROBOR to increase further, and naturally some extra liquidity in the banking system could have contributed to this.
Alex, we just didn't catch your second part of the question, but Mihai was trying to answer it, hopefully in full.
Yeah, I had a slight glitch with the connection. The second part was related to what caused the ROBOR rates to drop near the key rate in the last months.
Yeah, I think I replied those.
Yes, you did. Yes, you actually did. Another question regarding the exchange rate. Do you think that the euro-RON increase in the last days is a temporary one, or are we heading to a higher exchange rate? Maybe past the 5 lei for a euro mark.
Yeah, I don't know, Gergely, do you want to reply or should I? Because these are like between us.
My view is that the Romanian Central Bank implied very tight control on the exchange rate in the, let's say, for an extended period, and of course, because of the inflation difference and because of let's say the high current account imbalance, there is a risk that gradually the RON will move higher against the RON, but let's say from a historical comparison, and especially if we compare the changes in the RON to the HUF, I would say that these changes have been really modest so far.
Actually, if I just add one thought on this that Gergely partly mentioned, but so Romania has a relatively large current account deficit, like 10% of GDP, almost 9, and 9.3 was last year's figure to GDP. And the interesting point in this that, well, Hungary had almost 8 point something, and several regional economies, but in most CE countries, the big increase in the current account occurred because of the energy price increase. Why in Romania, it had a relatively moderate effect. Like the Romanian current account was about 7% of GDP already in 2021. So the current account in Romania is more structural, and this means that probably there's some room for a weaker exchange rate from a competitiveness point of view. But on the other hand, as long as the fiscal consolidation goes ahead and the budget deficit declines, it will improve the current account position, and then it doesn't necessarily need to lead to a weaker exchange rate, because then the external balance improves as well.
Right. Thank you for the context also. And we have a few minutes until the end of this session. So I will address one last question from our audience. This is quite a detailed one. Do you think that Romania will progress with the resilience program past the current mark? The next milestone will be the reform of the special pension system, and the ruling coalition seems that it will not deliver one. What will happen if Romania's macro balance, if the flow of the EU funds will be hampered? Can we attribute the recent problems of, let's say, Hungary to the lack of EU funds inflows? Meaning that are we at risk of, let's say, losing some EU fund inflows if we don't have this pension reform? And if you can have a comparison, can you attribute to Hungary such a problem because of the lack of European funds?
Okay, so if maybe I will give some short sentences in Romanian. I don't know. I will ask whether the others want to address the other part. As far as I followed, this special pension problem, it's around the disbursement of 0.5 billion euro or something like that for Romania, if I can remember well. But what is absolutely clear that this is just a relatively small component compared to the whole recovering and resilience facility, and even more a small component if we add up all the different funds coming from the European Union, the recovering and resilience facility, the old 7-year budget, so the 14-20, and the new, the 21-27. As far as I know, there are no general problems with EU fund inflows from Romania. There can be certain programs where the milestones are not met, then those disbursements are halted. But so far, in my understanding, these are small compared to the overall packet of funds that Romania is receiving from EU sources.
So it can be overcome.
Yeah, I think so. But on the other hand, I don't want to speculate from here whether this pension reform will be done or not. We will see. I also followed the news flow in this respect. Let's see.
And maybe I can add that take into account that right now Hungary is facing de facto all funds frozen. I think the situation cannot be compared to Hungary. Take into account that Romania, a small fraction of funds, let's say, is on the table regarding in Hungary. The whole 7-year budget and the reconstruction and resilience facility right now is, let's say, suspended as long as the milestone had not been met. So I think the difference is very large.
All right, so we don't have a likeness and can't really compare the different setting, different problems. Thank you for the context, Gheorghe. So we're closing into our session today. This is about the time we had for this. So I will ask the audience, if you have further questions, please address them on email. We'll try to answer bit by bit every question you have, so all this can be clear. And sorry for that. And I would like to thank you to our presenters today. Thank you also for attending this event, a larger audience today. Great one. And we also hope this insight will help you better navigate the upcoming events and economic developments. So keep an eye on figures, keep an eye on trends, be prepared, and have a great day, let's say. Thank you.
Right.
Thank you. Bye-bye. Thank you, Alex.